$30 billion. Vaporized in a single afternoon. That is exactly what happened to IBM this week. Their worst single-day stock drop in over 25 years. A brutal 13% wipeout that left institutional investors completely stunned. And it was not a missed earnings report. It was not an accounting scandal or a macroeconomic shock. It was a simple blog post from Anthropic. So what did Anthropic say that terrified Wall Street so badly? They said they could finally read the oldest, ugliest, most profitable code on Earth. Welcome to the new game. I'm going to break down the COBOL trap, why the market panicked, and why the old rules of tech investing are officially broken. To really understand this $30 billion bloodbath, I have to talk about plumbing. Specifically, the invisible financial plumbing from 1959. It is called COBOL. It is an ancient, highly resilient programming language that quietly powers 95% of ATM transactions in the United States. Hundreds of billions of lines of this archaic stuff are running the world's major banks, commercial airlines, and federal government agencies every single day. And almost all of it lives on massive, incredibly expensive IBM mainframe computers. It is the ultimate toll bridge of the modern economy. And Wall Street absolutely loved it until Anthropic decided to blow the bridge up this week. Meet David. David is the chief information officer at a massive global bank. David makes a lot of money. But David lives in a state of low-grade terror. Why? Because the core systems handling trillions of dollars in daily transactions at his bank are written entirely in COBOL. And the specific engineers who originally wrote that code retired to Florida 20 years ago. Universities do not teach it anymore. The global talent pool is shrinking fast. David is essentially living in a $10 billion mansion, but the internal plumbing is from the Eisenhower administration. And if a single pipe bursts, the whole bank goes offline and he loses his job. So what does David actually do? He pays the toll. He hires massive armies of consultants, usually from IBM, just to keep the lights on and the code running. Modernizing these systems historically required hundreds of humans spending years just to map the basic workflows. The golden rule of enterprise tech has always been this simple fact. Understanding legacy code costs significantly more than rewriting it. IBM built a massive high-margin consulting moat entirely around this exact pain point. They were the premier hostage negotiators for the global financial system, charging premium rates just to look at the blueprint. Then Monday happens. Anthropic announces that their new AI tool, Claude Code, can automate the modernization of COBOL. It can instantly ingest thousands of lines of ancient spaghetti code, map the complex dependencies, document the forgotten workflows, and translate it into modern languages. Anthropic stated plainly that AI officially flips the equation. What used to take years of incredibly expensive human consulting could now take mere quarters. The fundamental bottleneck was never writing new code. It was the painful process of reading the old code. And Claude just learned how to read faster than any human alive. Wall Street took one look at that single blog post and immediately smashed the sell button. IBM stock plummeted into the abyss. Why? Because the market suddenly realized that IBM's impenetrable consulting moat might actually just be a puddle. If David the CIO can use an AI agent to analyze his legacy systems for pennies on the dollar, he simply does not need to pay IBM millions in billable hours to do basic discovery work. The structural reset is here right now. The market is violently repricing any company whose business model relies purely on human friction. And the panic absolutely did not stop with IBM. The market contagion spread instantly. Major IT outsourcing firms and legacy cybersecurity stocks caught the exact same flu. Because if Anthropic can seamlessly automate legacy code discovery, what else can they automate? Investors are terrified of this new SaaS assassin taking out entire sectors. But here's the billion-dollar question you have to ask. Did the market wildly overreact? Is IBM's legendary mainframe business actually dead in the water? I'm taking a breath and looking at the cold reality. Wall Street is in a panic mode, but they are entirely missing the bigger picture. Translating a 1960s COBOL script into a modern Java application is actually the easy part of the job. It is maybe 20% of the actual enterprise migration problem. The other 80%? That is what I like to call the compliance theater. You see, David's bank does not just run IBM mainframes because they have some weird nostalgic love for COBOL. They run them because the hardware and software are tightly coupled to pass brutal, uncompromising regulatory audits. PCI compliance, SOC 2, intense banking regulations across multiple jurisdictions. AI absolutely does not automate the federal regulators. You cannot just slap an AI-translated Java application onto a public cloud server and call it a day. Doing that without triggering a catastrophic regulatory nightmare is literally impossible for a bank. The syntax of the code itself is easy to flip. The security protocols, the strict data governance, and the unbreakable audit trail? That takes years of manual human sign-offs. IBM's real economic moat is not their unique ability to read COBOL. It is their ability to provide the certified compliance envelope that keeps CIOs out of federal prison. The market completely ignored this crucial nuance. And here's the ultimate, hilarious irony that the sophisticated trading algorithms selling IBM stock completely missed. IBM already has an enterprise AI tool that does exactly this. It is called Watson Xcode Assistant for Z. Yeah, a funky name, I know. They have been using a massive 20 billion parameter model to refactor COBOL for well over a year now. IBM's leadership fully knows the game is changing. They know the future of their revenue is not charging for manual code discovery. It is strictly about charging a premium for the secure, fully compliant execution of that generated code. So exactly where does that leave you as an intelligent investor? It leaves you looking at a market that is deeply, fundamentally confused about the difference between a neat software trick and hardened enterprise architecture. The old rules of investing are completely broken. You can no longer look purely at historical margins or outdated P/E ratios. But the new rules do not mean every single legacy tech company goes to zero overnight. The real financial winners in this structural reset will not just be the AI models writing the code. The ultimate winners will be the platform companies that successfully own and manage the enterprise risk. I'm seeing incredibly violent mispricings across the board right now. You saw it with SaaS stocks tumbling violently last week, and now you're seeing it happen with legacy hardware infrastructure. Every single time Anthropic or OpenAI drops a new update, you should fully expect a $20 billion hole to get blown in some random sector. But as an easy mode investor, your job is not to join the panic. Your job is to ruthlessly analyze the business model. Look closely at the user experience. Look at who actually owns the catastrophic downside risk. If a company's only competitive moat is that their proprietary software is really hard to understand, they are completely finished. AI algorithms will crush them into dust. But if their core moat is holding the regulatory compliance envelope for the entire global financial system, they are not going anywhere anytime soon. IBM's consulting revenues might take a serious haircut this year, but their mainframe hardware architecture? That is a much harder nut to crack. The toll bridge is definitely changing, but the river of money is still flowing underneath it. IBM's worst day in 25 years was a massive wake-up call for the entire industry. The AI disruption is moving swiftly from the creative class straight into the engine room of the global economy. AI is no longer just writing polite emails. It is actively rewriting the core financial plumbing of the world. But remember, David does not buy clean code. David buys not getting fired by his board of directors. Human-led compliance is here to stay for a very long time. So I want to hear your completely unfiltered take. Are we looking at peak Anthropic hype right now? Or is this actually the beginning of the end for the mighty IBM mainframe monopoly? Drop your thesis in the comments below. And if you want to get through this massive structural reset together and actually understand the raw business models behind the flashing tickers, hit that subscribe button. I read the boring 10K and 10Q filings every week so you do not have to. See you in the next one.